G'day everyone, back to Pete's Investing. Today we're going to be explaining the trading strategy with a CCI and Average Down strategy. So in today's content we're going to be talking about some basic money management ideas, what types of shares to buy, when to sell if the price goes your way, and when to sell if the price goes against you. As always, don't forget to look at the refer to the Pete's Investing channel with the playlists, and that's where we log our weekly indexes and share price reviews, but also our strategy playlist. And that's where we cover the simple trading strategy in a different way, and also the money management ideas explained further. Again, we're not offering financial advice, it's purely an educational video series. So in terms of basic money management, we're looking at starting off at how do you put aside some funds from your from your pay, and after you pay off your essential bills such as rent, utilities, dining out, groceries, etc. So if you're getting paid, for example, $5,000 a month, you put aside $1,000 a month toward your trading strategy or trading account. Or if you get paid $3,000 a month, put aside maybe $500 towards your trading strategy. So you can start small, not a big deal, and as you grow your trading account, you can actually make bigger trades per transaction. Again, don't use your essential income to trade. I suppose what I'm saying. It's basic, but it needs to be said. So how do we go about using your investment accounts? So let's assume you've got a $10,000 account to start with. And again, this could be a $5,000 account, but you can basically halve this or double it depending on your investment amounts. So if you've got $10,000, you want to trade with, say, $1,000 worth of shares for each transaction. So every time you buy a lump of shares, you buy $1,000 worth. And we want to buy no, so if you've got $10,000 and you're buying $1,000 worth of shares, you buy no more than 5 companies, 5 lots of shares in 5 companies. So in other words, you've put aside, you've invested 50% of your investment account, and you have about $5,000 remaining in your investment account. Now there's a reason for that. So again, I'm suggesting putting aside $1,000 trades per transaction. So again, you can double or halve these amounts. I'm just giving you an example using $10,000 amount for account value, but trading $1,000 in transactions. So I'll always put aside 50% of your funds. I'll explain what that means soon. We only buy blue chip shares. These companies generally have a good history of reliable growth. They pay dividends, i.e. interest. Same as your bank interest, yet they pay interest or dividends twice a year. This is important to give you some return on your investment, better than bank interest. And also, we're looking for yields. Dividend yields are between 1 to 6% is reasonable. The lower dividend yields generally mean companies pay their shareholders some of their profits and reinvest the rest back into the business. This usually equates to company growth. And that's what we want to see in a share price, the share price growing. Our primary goal is to make profits from buying and selling shares, and our secondary goal is to make income from those dividends when price goes against us and we're waiting to sell. So let's get started. So here we're looking at a share price, which obviously is appreciating. Again, we're looking at the buying when the CCI14 commodity channel index crosses above the 0 line. So here you can see it's crossed above this. This is a 0 line. And the commodity channel 14, CCI 14, is crossed above the 0 line. So we buy a first lot of shares there. The entry price in this example is $95.58. We buy 10 shares at a cost of $955.80. Okay. We put a minimum target price of 5% gain, and that's what that pink line represents. So a minimum target before we sell must be at least 5%. You can see there after a few days, the price has shot up past that 5% mark, but we're not selling yet. Why is that? We want to sell when this is a moving average 20. We want to sell when that moving average 20 starts turning down. You can just see that there. When it's rising, I put it in a blue. When it starts going down, it becomes red. And that's where we sell out and we close the transaction. Moving averages, for those that are not aware, can be found on most charting software from your broker, and where you go in your broker account, most banks have a brokerage account set up. So most broking transactions or most broking software has very simple indicators such as the CCI and the moving average indicator. So this is a simple moving average 20, and this is this commodity channel index of 14. So again, we sell when the moving average, when it breaks above the minimum profit of 5%, and when the moving average breaks into a negative, and it has there. Now it's gone up, but we're going to take our profits there because we don't know if it's going to continue up or whether it's going to go down. So as soon as that moving average 20 breaks into a negative, it's starting to turn down, that's when we sell. Our exit price is 125.94. So if we sell now 10 shares at 1,259.40 cents with a minimum purchase price minus the purchase price, and that returns us $303.60. So just reviewing, remember we bought 10 shares at 95.58. We sold at 125.94. So that gives us $303.60. And that doesn't include brokerage. So depending on your broker, if you're paying $10 per transaction, that means minus $20 off that. Or if you're paying $20 per transaction, minus $40 off that. So you've got to factor that in your return. The trading the average down strategy, how to trade if price goes against you. So in this example, you can see here the chart. We buy when the CCI 14 breaks above zero. We buy there. The share price is going down. Our entry price 146.53, and we buy 7 shares. So that's going to cost us $1,025.71. So remember factoring in your brokerage now. So if you're paying $20 in brokerage, that's going to cost you $1,045.71. Anyway, we bought 7 shares at 146.53 in this example. The price goes against us. So what do? So again, as per previously, we set a minimum 5% gain, and that's our pink line there. So our target price is our minimum 5% gain. It's our first step we initiate. But again, the price is going against us. Price drops and tracks below the initial target price. So we haven't hit that initial target price of 5%. What we do then is we say, righto, if the price has dropped by 30%, we want to buy additional shares, and we put in the green line here indicating the 30% drop of price from our initial entry point. So when a price drops below that and the CCI 14 crosses above the zero line like it has there, that's when we buy more. Now you'll notice the price has dropped below the 30% decline. The CCI hasn't broken above the zero at that point. We want to make sure it drops below the 30% decline and the CCI breaks above zero. Now it's broken above zero there, but our price has gone above the minus 30. So we don't want to buy any more shares at that point. Same applies there, we're just below that. But when it breaks above zero, the CCI breaks above zero, the price also goes greater than the minus 30 there. So it happens again another 2 times there. The CCI is still below the zero line. Until it gets to this point, we buy additional shares because it's broken below the 30%, the minus 30%, and its CCI 14 is broken above zero. So here we buy 10 shares at $104.68. So now our new minimum target price, we buy the second lot, a new minimum target price is there. Remember, our initial target price was up here, once we bought up here. After buying that lot of shares down there at 104.68, the new average price drops from there down to there. So we wait for that moving average 20 to break below zero. You'll notice there it's broken below zero. We don't care about the CCI 14 anymore. We focus on the moving average 20. So it's broken below zero. Sorry, it's the moving average has gone into a negative, but it hasn't broken above our minimum price, minimum target price. It recovers, goes above our minimum target price, keeps going, and you can just see it there. It's a bit hard to read, but that actually has broken below the moving average, has started to break into a negative. That's where we sell. So the exit price is 143.84. We sell 17 shares, and that returns us $2,445.28. minus the purchase price of one. So we bought one lot at 1,024. We bought the second lot at 1,046. So 2,445 minus 2072 returns 372 and 77 cents. And again, minus any brokerage. So you would have bought once, twice, and a sell. That's 3 brokerage costs. So you minus, in this, so let's say your brokerage was $10 per transaction. That's $10 times 3. So minus $30 off that if it was $10 per transaction. That's your trade for the average down process. Remember, always refer to the our playlists, where we review our strategies, our share price reviews each week, and our indexes each week for updates. Thanks very much, and speak to you next week.